Module 4, okay, business risk analysis. Okay. As we said, we define the business risk as those risks that impact upon the business in both its external and its internal environment. Now, what we need for this, again, is a structure. So we will look at the structure for assessing business risk, and again, we will break it down to its constituent parts. So we're going to start from the top. We'll start from general risks that the business may be impacted upon. Then we'll come down and look at the industry itself. So having defined the industry that the business is in, what are the specific risks in that industry as opposed to the general risks? And then we're going to come down and look at the corporate or the company, its position within its industry. It's a funnel approach. So those are the external risks, and then the internal risks, it's what's referred to generally as operational analysis. Those things the company has a degree of control over. And then finally, we will look at our assessing management, because above all of this sits the management. So let's start by looking at a structure for an analysis. Okay. Now, we started by looking at three types of risk: business risk, financial, and structural risk. Let's just take the two of them, the business risk and the financial risk. Okay. Ultimately, what we are concerned about is the ability of the company or the corporate or the lending entity to repay its future obligations. This goes back to our definition of credit. Okay. Now, ultimately, what's going to repay future obligations is cash flow. So what we have to look at is what's going to drive that cash flow in the future. Now, when I first went into banking, what we tended to focus on was very much our financial risk. And what we looked at, we would start by looking at the income statement. We would look at our revenue. We would look at our earnings. That would be our assessment of repayment ability. And then we'd look at the balance sheet to see how the company was structured in terms of financing itself, and do we have lots of assets there to cover ourselves in the event of the company not meeting its obligations from repayment ability and us having to rely on our collateral. Okay. It was a pretty narrow, naive way of thinking. What we didn't take into account was the environment that the business was operating in. Okay. So we would concentrate on financial performance, but without thinking about the company's or the business's environment. Now, by environment, what I mean is both the external environment the company operates in and the internal, which I just talked about. Now, what we have to do now is take the historical performance and look at the environment that the business is operated in. Because what that does, it gives us a pattern. Given a certain set of environmental conditions, financially, how has the business performed? We've got a pattern. We've got a relationship. Now, we are concerned about the ability to meet future obligations. So what we have to do then is to anticipate how we think that future environment is going to change. Having established a pattern about how the financials of the business react to the environment, how we think that environment is going to change, what we can then do is anticipate what the future financial performance of the business is going to be. Once we've established what the future performance of the business is going to be, we can then assess future repayment ability. And remember, ladies and gentlemen, future repayment ability comes from cash flow. So what our focus here, the ability to meet future obligations, the primary concern is the ability to generate future cash flows. So let's start looking at the assessment of our business risk in a little bit more detail. Our business risk can be broken down, as I said, into two parts. The external business risk, which we can break down into the macro, the industry, and then the company itself. And then our internal business risks, which I am going to define as operational risks. Let's start with our friends over here. Okay. Macro risks. One of the most common techniques for assessing macro risks is what's referred to as a PEST analysis. PEST standing for political factors, economic factors, social factors, technological factors. And against each of those, we have a number of considerations. Now, any business is going to be affected by these to a greater or lesser extent. Some will be affected by these on all four of the factors, others by just a few. So let's take a simple business like a confectionery manufacturer. Something like a Hershey's or a Cadbury's. What political factors does it get influenced by? Very, very few. Political factors would include regulatory issues. Economic factors. What economic factors would a confectionery company face? Again, very few. Because if we look at the economic cycle, we find that confectionery is one of those businesses that people tend to buy it irrespective of how the economic cycle is working. Social factors, maybe some exposure here. As people get more health conscious, maybe they start looking at sugar contents, fat contents. So it's up to the business to respond to this. Technological factors, confectionery, age-old process. Well, not quite age-old, but certainly hasn't changed much over the last few hundred years. Very few impacts upon it. So if we look at something like the confectionery business, very low pest macro factors that affect it. Let's take something in contrast like the real estate business. Okay, real estate subject to very high legal and political interference. Hugely economic factors. Yes, can be social factors as people's lifestyle and ages change. Technological, very, very few. So the business, depending on the type of business, will be affected by these to a greater or lesser extent. What we have to do, though, is make sure we address them as part of our analysis process. Once we've established what the macro risks to facing the business are, what we then need to think about are the key industry drivers. What drives this business? Okay. Now, we've already established some of those pest factors, the political, the economic, the social, the technological factors. Let's have a look at other things, such as, is the company subject to a lot of regulatory changes? What are consumer preferences like? You know, does the industry subject to consumer changes, and does this industry have to respond to those changes? What's the size of the market? How is the market divided up between the various players in the market? Does any player dominate? Is it dominated by one or two large players? So, for instance, going back to our confectionery, if we talk about our beverages, you know, we talk about the dominance of Coca-Cola and Pepsi. And all the other beverages players are really sort of third and fourth generation, you know, fourth tier, third and fourth tier, if you like. Okay. We sometimes talk about revenue volatility. As we go through the economic cycle, how does demand for the business, for the industry, vary? You know, is it one of those industries that we have a high volatility? So again, going back to our real estate, we look at real estate very much linked to the economic cycle. Going back to our confectionery, very, very little impact. What's the impact upon supply? Do we have any sort of factors, you know, any supply factors that are coming in? You know, do we have supply problems? Okay. Is supply flexible? Can we draw it off whenever we want? Okay. Let's think about distribution channels. How do we distribute? How is it distributed? Is it distributed through some sort of physical retail outlet, or do we internet distribution? We warehouse it. Okay. What are the CapEx requirements of the business? Is it a business that requires lots of CapEx? We've talked about some of the big industrial manufacturers. We've talked about airlines. Or can it operate on very little CapEx? Are we actually talking about service industries where there's virtually no CapEx involved? Okay. And do economies of scale play an impact on the business? Particularly when we get some of the larger industries, we're talking about the pharmaceutical, the breweries, these type of things, and even banking, where economies of scale are absolutely critical.